afternoon. My name is Sean Williamson, and I'm a partner here at Allegiance Financial Group Advisory Services. Along with my other partners, Asaf Pinchas and Charlie Cook, we would like to welcome you all to our webinar today, and we appreciate you taking time out of your busy schedules to join us. So a few housekeeping items first. Everyone will be on mute for this call. If you have a question, please type it in the Q&A box. We will try to address all of the questions if we have time. But if not, we will circle back and discuss with those with you at a later time. This call will be recorded and available for replay. So through the years, we have various partners that we work with closely to enhance our client experience and bring added value. We are very excited today to have Apollo Lupescu with us in this town hall format. Apollo is the vice president at Dimensional Fund Advisors, which manages over $750 billion in assets, making it one of the largest investment firms in the world. He started there in 2004 after finishing his PhD in economics and finance at the University of California, Santa Barbara. He has expertise in a wide variety of areas, and he frequently speaks around the country and the world at various advisor conferences and individual investor events. So prior to joining Dimensional, Apollo had his own consulting firm, which he provided services for the U.S. State Department and the White House on various projects. So without further ado, I would like to introduce Apollo Lupescu.
Well, hello, Sean, and thank you so much for the invitation to be here, and thanks to everyone for taking the time to attend. And I'm really excited because I think this webinar is very valuable, particularly when we see everything that's going on around us. So thank you for the invitation. And kind of my goal for the next hour or so is to demystify and clarify a lot of the issues that you see out there in the world and how they relate to your money.
Perfect. So again, kind of what you said, with everything that's going on in the world today, from the conflicts in the Middle East, Ukraine, interest rates, inflation, and right around the corner, the election here in the United States, I think it's a great time to have you to really kind of give us your thoughts on these topics that are going to be front and center of our clients' minds right now. So why don't we go ahead and get started? So Apollo, one of the questions that we kind of get is regarding interest rates. Right, so we've had one of the quickest interest rate hiking cycles in a generation, and then just recently the Fed has lowered them. So I assume they're going to be, lowering through the rest of the year and into next year. So what action should clients be thinking about with this in mind moving forward?
Yeah, and you're absolutely right. So these interest rates changes that you've heard so much about. First, like since 2022, we've had this big rise, and then now that they're coming back down, the whole background of the interest rate changes has to do with inflation. And then you really want to understand. Let's understand why it's happening the way it is. And to do that, we need to go back to the last time that we had high inflation in the U.S., which is in the 1970s. And I think it will really inform what's going on right now and what to expect next. So back in those days, there are two major events in the early 70s. The first one being that the U.S. economy was growing and growing and growing. We had more people in society. And yet at the time, in order for the U.S. government to print a dollar bill, it needed to have gold in the bank because the gold was tied to the dollar. And as we expanded as an economy, a number of people, we were just not digging up enough gold to print enough dollar bills for the economy to grow. So in August of 1971, President Nixon goes on TV and tells the world that as of today, the dollar is not linked to gold anymore. And the practical implication of that was that the dollar is now just not linked to any precious currency, meaning that the government can run the printing machine day and night with no backstop. And that clearly caused some anxiety among the citizens of the country. Imagine if you're told today that the government can just print as many dollar bills as it wants. A lot of people were concerned that we might not be responsible with the government being entrusted with this, and the dollar is going to be worthless. So what President Nixon did, he put in place a 90-day period when he cannot increase prices or wages just to kind of manage that behavioral element. And that 90-day price and wage, turns out that it lasted till about January of 1973, about a year and a half. So if you have about a year and a half when you're not letting supply and demand and market forces drive prices, when you release that valve, boy, that the flights are going to fly through the roof. So we start seeing inflation in early 73. And on top of that, we had a big oil crisis because at the time we're not producing much domestic oil. And OPEC decided not to send oil to the US because of a conflict in the Middle East. And all of a sudden we had a big energy crisis. So, Sean, in the 1970s, we saw inflation going up significantly, and the Fed basically stepped in and said, if we increase rates, well, consumers are going to have less money to spend on goods and services, and businesses are not going to invest as much, and that should reduce the pressure on. That when inflation came down, so did the economic activity. And seeing that the Fed was like, oh, just kidding, we don't want to hurt the economy, so they flip-flopped and they cut rates, and they did this several times in the 70s. And the result of that was that an expectation that the Fed is not serious about fighting inflation, and inflation will stay high. And the problem was that the expectation of high inflation became a self-fulfilling prophecy. Per year over the next few years, well, you're going to fight to bake at least a 10% increase in wages, which is going to lead to prices staying high. And that happened until late 70s, when a new Fed chairman, Paul Volcker, came along, and he said, no more monkeying around, no more flipping rates. We're going to stay with high rates until inflation comes down to our desired target, and we reassure everybody in society that the Fed is serious about fighting it. And that's exactly what he did. And we did have a recession in the early 80s, but what we had afterwards were pretty much 40 years of price stability built upon the idea that if inflation was to come back, the Fed would be really serious about fighting it. So in 2022, as inflation went from 5, 6, 7, 8%, the Fed jumped into action. They sprung into action. And what should they have done? Exactly what you and I probably think intuitively should have been done, which is raise interest rates to the point where first of all, everybody in society knows that the Fed is serious about fighting inflation, and secondly, that we know that inflation is contained. That's exactly what they've done. They've raised rates. They stayed with high rates until inflation has kind of come down, and as inflation has come down to exactly like below the long-term average, very close to their desired target. The Fed is not in the business of hurting the economy. They said, okay, people are reassured that we're serious. We didn't jump the gun and cut rates too early. The inflation is where we want to be, so might as well give the economy a bit of a boost, even though it doesn't really need it. Like, the economy is doing very well. So just to give you some background, folks, the reason the Fed is doing this, has been doing this, was to fight inflation. Once inflation is under control, which it is today, and once people are reassured that the Fed is serious about it, then there's no really a big need to stay with really high rates. Now, yes, Sean.
Well, I was going to just ask a question. Do we in the financial markets, we always hear that the Fed typically is behind the curve, right? We hear that oftentimes, but yeah. I think they're always in a tough spot in terms of whether to raise and hurt the economy or not and let inflation take off.
Absolutely. And in this particular case, there is no playbook to say exactly that's the day when you ought to do it. There is a judgment call. And in my personal opinion, it was kind of the right judgment call, because the danger of sending a signal that we're more concerned about the economy than inflation would have maintained perhaps higher inflation. But the signal that they sent very clearly. Now, could they have done it a month or maybe? But there's another thing that goes into this. When we talk about interest rates, Sean, we got to be aware that there's not one single interest rate in the country. And in fact, one of the primary drivers of the different interest rates has to do with the length of the contract for which money is borrowed. So what a bond is, which is most often what we quote here in terms of interest rates, a bond is a form of a lending where, let's say the U.S. government comes to us and says, listen, if you give me $1,000, I will pay you interest, and we'll have a contract that specifies for how long I'll pay you that interest rate, and at the back end, I'll pay you back the $1,000. That's what a bond is. And it turns out that historically, we have seen a relationship between the interest rate that somebody gets, and the maturity of the bond, maturity meaning the length of that contract. And that relationship is quite interesting. It's also instead of interest rate, you also hear the word yield. It's kind of the same thing, how much you make on your money. And if you lend the U.S. government, say, your money for 30 days, well, that you're going to get a certain interest rate. And it's not that high because it's a highly credible borrower and it's only 30 days. Now, if you lend them the money for 1 year, most investors would say, hang on a second, your money, you're going to have my money for a year. My money's locked up for longer. So you have to pay me a little bit of a higher rate. And then if you want to give the money for 5 years, well, I do expect an even higher rate on my money. And when you look at 10 or 20 years, absolutely, I want to maybe a little bit higher rate because my money's locked out for longer. And it turns out that if you connect all these dots, you get something that in technical jargon is called the yield curve. And this is something that is called a normal yield curve because that's sort of the way that naturally happens, and intuitively it should be that way. That the longer your money's locked up, the higher the rate. Now, over the past 2 years, since the Fed has jumped into action to increase rates, we have seen two things that are quite interesting. The first one is that we went from an interest rate of almost zero for these 30-day type of investments to one that went almost to about 5.5%. So a huge jump in these very short-term types of contracts, the 30-day investments into government bonds. And that's one thing, the huge jump. But secondly, we saw that if you're now lending over the past couple of years the money for 1 year instead of 30 days, instead of making more money, your interest rate is lower. And if you go to 5 years, even lower, and it's kind of about the same for the 10 years or 20 years. So in other words, we still have that connection between the interest rate and the maturity that makes it a yield curve. But now it's called inverted because it's a bit upside down. It's not the way that the normally is. If you look at the historical data, normal is pretty much present most of the time. And the reason I bring this into consideration, Sean, is because when the Fed is raising or lowering rates, they typically tend to impact primarily this very, very short-term type of lending, very short-term lending. And the way that it matters to us is because if you are a business owner and you want to take out a loan to make payroll for a month or so, well, by having this huge bump, you would have paid a pretty high interest rate on that loan, which would not make you happy as a borrower. On the other hand, when these interest rates jump with the Fed making all these moves for the past couple of years, one of the biggest beneficiaries were the folks who needed some money into a certificate of deposit or CD or a money market fund. Because instead of making pretty much 0%, as it was the case for years, all of a sudden you can make 5% on your money in these guaranteed investments, which is a very big deal for a lot of folks. So as the interest rates drop now, two things are going to happen. If you're a business owner, you're going to be very happy because now you pay less, and you might encourage you to make some other investments. And at the same time, if you are a saver and you got used to this 5% on CDs and money markets, well, don't get too comfortable because likely you're not going to get that over the long run, particularly as the Fed might continue to drop rates. So that's the first comment. The second comment I want to make is that when you look at the longer term rates, the 10 years and so forth, those are at the long end, those interest rates are not really driven by the Fed. I mean, if you think about this, these rates haven't really changed that much over the past 2 years. And in October of 2023, about a year ago, the 10-year interest rate on government bonds was about 5%. And in September, and this is even before the Fed started to cut rates in 2024, about a year later, it had dropped to about 3.6%. And that's with the Fed making no move, because a lot of these rates are not driven by necessarily by the Fed. So when the Fed changes something, it's at the very short end. It might impact the CD holders or the business owners who borrow for short term. But if you are looking for a mortgage that mortgage is tied into the 10-year government interest rate. And that one really hasn't moved. It's moved up and down a little bit. And the dynamics of that are not really driven by the Fed. So just because the Fed cut rates, don't necessarily expect that that's going to translate into a lower mortgage for you. It might or might not, because the dynamics of the 10-year are completely independent they're completely independent of the what the Fed does, and that interest rate tends to change quite a bit, much more so than the Fed makes changes to its own rate. So be careful with that.
So, speaking on how this affects a lot of the bonds and short-term interest rates and things that we can earn in cash or CDs, what do you think the impact this will have on the stock market?
So a lot of times so we looked at this because it is a very important question, is that how is the Fed interest rates impacting the market? And I think there's a certain conventional wisdom that when interest rates go higher, it makes it more expensive for companies to borrow, and therefore perhaps market might not do very well. Anyway, so let's look at the data. Do we have situations where the rates go up and down? And particularly when rates go up, that's when a lot of investors tend to supposedly be more nervous. So we looked at this going back to 2000, and we looked at times when the Fed changed rates. So in the early 2000s, we saw a big drop in the Fed interest rate, which is the one that they more specifically control. That's a very, very short term, even shorter than 30 days. And then here's the thing: between 2004 and 2006, we saw a very big increase in interest rates. And then it dropped again with the financial crisis, and it kind of stayed very close to zero until 2016 to 2018, when once again we saw the rates going up. And then over the past 2 years in 22, 23, once again we saw the rates going up. So the question is, when we see these case studies with the rates, we'll just use a situation of the rates going up, how is the market reacting to that? So when you extrapolate, when you put on top of this graph the performance of the S&P 500, which is the stock market in the U.S., a measure of the stock market in the U.S., what you see is in 2004, even as the rates were going up, the market did really well, a little bit above long-term average. 2005, another positive year. 2006, another significant positive year. So we have 3 years of back-to-back-to-back increases in Fed rates. And the market goes up every single year. So it doesn't seem like there's a clear evidence that this period led to a disaster in the market. In 2016, once again, we had a market going up, and 2017. And in 2018, we did see a drop. It was the third year of these rate increases, and the market did go down. And then obviously 2022, we had a pretty significant year down, but 23 was a significant year up, even as the rates continue to climb. So when you look at the data, not just an opinion, but data, it just doesn't appear there's an obvious relationship between, let's say, the Fed increasing rates and how the market behaves. It could be that the markets go up or down. It's not obvious. I mean, obviously, we had two out of the last 8, so about 1 in 4 when the rates were going up and the market went down, and 3 in 4 periods then it didn't. So 6 out of 8 didn't, and 2 out of 8 they did. So it's kind of very similar to the historical average, and because of that, I would say that investors ought not to be terribly concerned to make a decision about their money solely based on the Fed. So this Fed certainly impacts some companies. It's just not a primary driver of the stock market.
Okay, great. Now, kind of maybe following on to that, you had mentioned something before about the government debt. Being right outside of DC here in Virginia, it seems like there's a tremendous amount of dysfunction in the political landscape. Can you speak to the concerns over, we get a lot of clients talking about both the deficit and the debt. Can you talk about that and how that may have impact markets and distinguish between the deficit and the debt for our guests?
So I'm so glad you brought it up, because it sometimes can be very confusing. So what is the deficit? What is the debt? So let's just make it pretty clear. So let's just say that this is year 1. So we're going to start with year 1, and then the government collects a certain amount in tax, and there is a certain amount of spending. And let's say that for this year one, it collects in taxes about $100, but then it ends up spending about $105. So ultimately, because the spending is more than what we bring in revenues, then you see that there is a negative 5%, a negative $5 in this case, which is what we what we spend more than we get in taxes. And for this year one, this is called the deficit. So the deficit is what happens in any single year when you collect in taxes less than you spend. So now if we go to year two, in year two, perhaps now you have the taxes perhaps being 105, and the government now spends a little bit more, so it spends 115 perhaps. So at this point, the deficit in year two, the deficit is about 10 because we spend $10 more than we collected in taxes. So over year one, we have a $5 deficit, and then over in year two, a $10 deficit. Now, as you accumulate all these years, the debt is basically the debt is the sum of deficits. So in this case, it would be 5 plus 10. So over these 2 years, we have accumulated a debt of about $15. So the debt is just simply like you add up together all the deficits across years and you get the amount of money as a whole that we owe as a country. And that number at the beginning of 2024 was a whopping $34 trillion. $34 trillion. So this is the sum of all the deficits that we've accumulated year after year since the beginning of the country. That's kind of where it goes. But thing, Sean, is that this debt has been kind of growing quite significantly. In the early 90s, that number was closer to $4 trillion, and now it's at 34 trillion. So it's really moved up quite a bit. So what is going on here? That's one question. Second is, how burdensome is this on all of us? And then the third one is this sustainable? So let's start with this. The first question is, sort of like what's going on in here. It turns out that on what I put on the spending by the government, there are two very distinct tracks for government spending. There is a government spending that is tied to a law. So if there's a law in place, then you have to spend the money for that law. And a good example of that is Social Security and Medicare. That is a law that we have to fund. And that alone, Social Security and Medicare, is roughly about half of the entire spending of the federal government. And that is part of what's called mandatory spending. So mandatory spending means that there's a law and we have to spend the money. We have no choice. If you add on top of the mandatory spending the defense, which is something that we absolutely have to do as a country, and also the interest that we have to pay on the debt, that amounts to about 80% of the entire spending of the US government. Meaning that if you think about it, $4 and $5 is pretty much pre-spent. There's not much of a choice that he have. And what's left is a much smaller balloon that he can squeeze around. And that's what makes it so hard to handle the deficit and the debt, is because so much of it is already baked into this mandatory spending. And the other part called discretionary, it's not that huge. And then you have to have FEMA. I mean, all the disasters going on across the country, you have to have FEMA, you have to have highways, the National Institute of Health, you have to have education, you have to have, housing and so forth. So there are a lot of other things that you have to fund from that. And that's why this is such a big issue that really is more political, somebody having to have the political will to make some changes if we really want to take care of this. And this is not my job to tell whether we need to tax more, spend less, or what we need to do in cutting some of this or increasing taxes. That's not my job. That's a politician's job, and you can go talk to them. Now, what about the burden, the economic burden of this debt? Well, it turns out that I mentioned that the way that the government borrows is by, let's say, taking $1,000 from me, and then there's a moment where they have to repay that principal, the $1,000. Well, what the government can do is go to Sean and say, hey, Sean, how about if you give me $1,000 and they can take his $1,000, give it to me, and in effect, push that principal amount further and further and further down the road. And the government can do that, roll the debt over and over and over again. But
The
the one thing,
proverbial kicking the can down the kicking the
exactly
can down
right. Now, whether that's good or bad, that's something that they can do. They've done it for a while, and there's nothing really outrageous about that. But the one thing that they cannot do is that they cannot get away with not paying interest. In my opinion, as an economist, the true burden of the debt is the amount of interest that we have to pay. And because the dollar value changes across time, I think it's good to make that amount relative to the size of the economy, how much we produce as an economy. So if you go back to 1990, when we owed $4 trillion, we actually had about 3.1% of the value of the entire economic activity of the country going into paying interest on the debt. That was the percentage. 3.1% of the value of the entire U.S. Economy, calls the gross domestic product, went into paying national debt, interest on the debt. What about now that it's 34 trillion? How much can it possibly be now? Turns out that the Fed actually keeps track of this number, and I'll share with you the website in a second. But at the end of last year, beginning of this year, that number stood at about 2.4%. It was actually less. And I know it's surprising, but it was actually less than he was back in those days in 1990. So how can that possibly be? Well, there are two explanations that kind of come to mind. One of them is that if you think about the size of the economy, it's certainly bigger today. The stock market, I think, is 10 times bigger than it used to be. So the fact that it grew in the number is not terribly surprising, because everything has grown in value since the 90s. But the second big one, which I think it's so interesting, is that the majority of this borrowing, in fact, by my accounting, it's roughly about 23 billion out of this 23 trillion out of the 34. So the vast majority of the debt was accumulated after the financial crisis between 2009 and last year, which means that the government was able to borrow at incredibly low rates. So even though we owe a lot of money, the biggest almost saving grace has been the very low rates. And if you look at the website that I mentioned a second ago, this is the Federal Reserve publishing the interest that we pay as percent of the gross domestic product, or the value of all goods and services that are being provided in the economy. What you see is that in the 80s, it came climbing and reached that peak in 1991. And then, people are very afraid where it's going to go from there. And it turns out that it went down, significantly down, and it continued to stay down. And even in 2021, this is like 3 years ago, we're about 1.5%, very low. And then the Fed started to increase rates. So we had to refinance the debt and roll the debt at a higher rate. So you saw in 2022 an increase. And then once again, as rates stayed high and the government had to refinance this, you saw this number going up to where it is right now at about 2.4%. And where it goes from here, it's going to be very interesting, because if the rates continue to stay relatively high, well, it's going to cost us more. If the rates come down, that's going to really benefit and perhaps drop back that percentage and the burden on all of us. So that's interesting, and we have to see where it goes. But the last question is whether or not this is sustainable. And I have to say there are different opinions, and depending on what news channel you might watch, sometimes there's a lot of fear mongering thrown at us. And the way that I want to think about this is not as my opinion or listening to TV, but I think of it as a market signal. It's a signal in which investors vote, literally vote in a way, with billions and billions and billions of dollars every day. Incredibly sophisticated investors, they vote not with their mouth, but with their dollar bills. And what is that signal? Well, it turns out that the government cannot force any of us to lend them money. We have to voluntarily enter into that contract with the government. So the government has to offer an interest rate that is attractive enough for us to invest the money. And on the other side, if we want too much as investors, the government say, I'm not going to do that. So it has to be a happy place where that interest rate has to be okay with the investors. It has to be okay with the borrower. And not too long ago, if the government wanted to borrow money for 10 years, that rate stood at about 3.7%. This is like, not too long ago. It's a little bit higher today. And the reason I bring this up is because I don't have to give my money to the US government. You know who else wants to borrow money on a 10-year bond, exactly the same premise? Mickey Mouse, Disney, actually. And if Disney wants to borrow money, they would love to pay 3.7%. But the market participants are saying, as robust as you are, as an amazing company as you are, you have to pay a little bit of a higher rate to compensate for the additional uncertainty. I don't think that you are as good of a bet as the US government. And that is reflected in the interest rate. And you can go further down. There are other great American companies, Ford, love their cars. They borrow money through 10-year bonds, but they have to pay 5.7% as a compensation for the perceived uncertainty of not getting the interest and the principal back. And again, Nordstrom, I love that the retail store, they can borrow money at a higher rate as well. So the idea here being that right now the signal is sent in the interest rate that the market sets, the market participants sets relative to other borrowers. And as we've seen in the past, and particularly now, the U.S. has the lowest interest rate among everybody who wants to borrow in U.S. dollars. Anybody who wants to borrow in U.S. dollars has to pay more. And this is the market sending the signal that despite all the nuttiness around the political system and all that, we have confidence that the debt is sustainable and the U.S. government will pay the interest and the principal that it promised to repay. And that's how the market participants are assessing that how sustainable is the debt. And if there's a day that comes when the market loses confidence in the government's ability to repay, the way it would manifest is in the interest rate that the government would have to pay relative to other bond issuers. And we're not in that situation right now, but you can look at other examples. Argentina, for example, they got in trouble. And if they want to borrow money for 10 years, they can, except that they have to pay a 16% interest rate on their 10-year borrowing, which is certainly a lot greater than the US. And it's a reflection of the perceived uncertainty around those investments. So to me, the long story here is that, listen, when you look at the deficit and the debt, these are very complicated because so much of it is already locked in stone in terms of spending. So there has to be some very tough political decisions to be made, number one. Number two, economically, the burden is pretty much the interest that we pay, not the amount itself. And even though the number has been getting greater, the burden is actually less than it used to be in the past. And number three is that investors are assessing the sustainability every day, every minute, and every second. And the way it's reflected, the signal that they're sending is the relative interest rate. And as of now, the U.S. is considered to be the most robust borrower out there in U.S. dollars. So right now we're not at that. We're paying attention to this, and we might or might not cross that bridge at some point, but we're just definitely at this moment in time, there's no doubt that the market sentiment is that the debt is sustainable.
Okay, thanks for that answer. A really quick follow-up to that, Apollo, is why did the government, when interest rates were at all-time lows, why did they not choose to refinance the same as myself or any of our clients would if we could get we had mortgage rates at 7, and when they got to 3, we refinanced. I heard a lot of talk about that. Why wasn't that a bigger deal?
Yeah. So there are two answers to this. So some of these bonds that the government issues, so the form of borrowing, let's say they have a 20-year contract, and let's say they enter into a contract at some point for 6%, and then the rates drop. Well, here's the thing. There's some bonds that are called callable bonds. And what it means is that the government can say, listen, let me repay you back the $1,000 and we call it a day. And that's fine. That's a callable bond. And there's some callable bonds. But investors don't really like that because if it's a callable bond, you know that if the rates drop, then you would be happy with the higher rate. But that's when the government kind of come and refinances that. So a lot more bonds are not callable, meaning that you cannot just end a contract. You have to stick with that contract till the very end. So that's the first answer, is that really some of these bonds, they could not be refinanced because the contract spells out that the government has to pay interest for the entire duration of the contract. The second answer to that is that it's a very interesting question of how does the government choose the length of the contract? And there's apparently one individual or one group that really has the ear to the ground and makes the decision. Are we going to borrow more using 2-year bonds or 5-year bonds and 10-year bonds? And those are very dynamic decisions that are driven by market demand to some degree. Because if you're going to say, I'm going to just issue 20-year bonds, but there are not enough investors out there who want the 20-year bonds, well, that's not going to work out very well. So there are more dynamic decisions that have to be made. But I have no doubt in my mind that for those callable bonds, absolutely the government has done it. And then secondly, I have no doubt that when they saw very high rates, it's possible that they loaded up more bonds at the 10, 20 year range, given that if there was a market demand for that. It's just that it's not, I don't know that I have the data to know exactly out of the borrowing, how much of it is on the short term, the 1 year versus 5 versus 10. I don't really have the data, but my guess is the government is quite smart about that because they've been doing it for so long.
It's not as simple as one of us refinancing our mortgage.
No, it's much more complicated than that, much because of these two features. One is the bond callable? Now our mortgages are callable because I can call it a day. But not most of the bonds. And secondly, the government has to go to the market and find out what is the true demand. Because I don't want to put out like so much money. I'm going to issue all these 10-year bonds, but there are not enough buyers because at that point, you're going to have to increase the rates to attract more. And that's not what they want.
Understood. Apollo, kind of moving, this is a question I think that's on the forefront of everyone's minds. We have an election here in the U.S., I think, in less than a month now. And it's a very divisive conversation. And, each election cycle, we have clients from both sides of the aisle that will get anxious and say, should we be proactively doing something, or I want to get out of the markets if my person doesn't win? So can you speak to what clients should be thinking about in terms of this election coming up and how it may affect markets and what they should be doing, if anything?
Yeah, no, and it's so interesting that he said that about the anxiety because I've been traveling the country over the past few months, and politics is certainly one of the top subjects of conversation. And what I've noticed, Sean, is that there is anxiety on all spectrum around politics. I mean, on some parts of the country, folks are worried that what if we have somebody with the most socialist views and the government is going to come in and tell us what to do? On the other hand, well, what if we have somebody that really lacks character and the temperament, and there's going to be chaos and perhaps autocracy, and they're concerned. So everybody's concerned about something. Anxiety is across the political spectrum, not only in one or the other. Also there's so many social issues right now that are touching our deeply held beliefs, our core identity as individuals. And because of that, we have very strong emotions about politics and election. And I have to say, these emotions are legitimate because that's what makes us human. And I think you ought to act upon those emotions the right way. We're fortunate enough to be in a free country. You can cast a vote. So go do that. Go cast a vote. Absolutely a great thing to do. Now, what I also found is that very successful investors in general honor and acknowledge those emotions. They don't brush them aside because they're real. And at the same time, they don't make investment decisions based on emotions, but rather on much more pragmatic reasons, such as data and evidence. What do the numbers say? And that's how they make decisions about their money. And that's what I'm going to do is I'm going to acknowledge these emotions and say they're real. And at the same time, try to pivot and say, whatever you feel is legitimate, but what does the data say? And what's interesting, Sean, is quite often the data is not really aligned with people's emotions. And I'll come back to this in a second. So let's go at a fundamental premise. What are we talking about? When you invest in the stock market, you are basically buying a piece of a company. You're buying ownership into a company like Microsoft, Google, McDonald's, Coca-Cola. You own a piece of that company and you are entitled to part of the profits that that company makes. That's what the stock market does. It's a phenomenal thing that gives us this stake in capitalism. And every single day, what the stock market is trying to do is assess what is the value of a company based on what I expect that company to earn in profits for years and years and years down the road. That's the game in the market. Tell me what to expect if I own a piece of that company. And that's the value that you see in the form of a price per share. And in that respect, what the stock market does is quite interesting because we have no clarity about what's going to happen, but it forms an expectation. And based on the expectation, it adjusts the price today. And when it comes to politics and elections, it's no different. What the market's really trying to do is assess how is this policy impacting the bottom line of a company and the possibility for earnings. But markets are forward looking. So, even before a policy is implemented, the market will actually incorporate that into the price. So whenever you think about the politics, it is not about the social issues. It's not about reproductive rights because that has nothing to do with Apple's profits. It's much more about the bottom line. How are these policies impacting the profits and the earnings of any one company? And there are two things that we found that was quite interesting. The first thing that we found is that the markets have gotten incredibly quick at pricing in those expectations. In other words, if there is a suggestion, there's a possibility that a particular policy or a particular candidate is going to implement, the market tends to react and increase or decrease the price of a stock very, very quickly. So by the time you read about it, by the time you think about it, chances are that the price has moved up or down. So if the expectations of good things, the price has moved up. So if you buy it, you might actually, so you feel great that I own that, but you might have bought it at a high price, which might not be a good deal anymore. And the second thing is that this is one of the many variables that might impact the stock market and a particular company. And it might not be the main driver. Even though it appears like that would be the case, it might not be that the government policies are the main driver of any company's profits. And let me illustrate with a couple of examples. In the previous administration, there was a point in time where they looked to promote domestic manufacturing. And they picked steel, the steel industry. And it turns out there is a company that carries the name of the industry. It's called United States Steel Corporation. And it's instructive to go and see how these two principles apply to that company. So when the administration came in, at the time, the price per share for U.S. Steel was kind of dropping and dropping and dropping. And at some point, the administration started talking about possibly introducing steel tariffs and make give U.S. Steel a big competitive advantage. Now, there was no clarity, but on the expectation that those might come, perhaps that drove the stock price up, and it kind of kept going up and up and up. And if you're an investor, you're saying, well, the government might put its weight behind U.S. Steel, but there was no clarity. There was no certainty whatsoever. There was an expectation that maybe these tariffs will come. And you know what? In fact, they did come. In March of 2018, the U.S. government imposed tariffs against foreign producers, giving U.S. Steel a huge leg up. So what happened if you got caught up in that seductive narrative that now you got the U.S. government, the policy of the government is to support U.S. Steel, and that's great. Well, over the course of that administration, the value of that investment have pretty much tanked. You would have lost the majority of your money in U.S. Steel had you followed that. And this is so interesting because that's not what most people want to believe. Like, no, you got the government behind it, so of course he's going to do well. You're going to do well as an investor. No, he didn't. Why? Well, I mean, one of the possibilities is that when you have tariffs that the U.S. imposes, it is quite likely that our trading partners are also going to impose tariffs, and it might hurt U.S. Steel more than it helped it. It could be that their strategy, their customer service, their product itself wasn't as competitive. Whatever the case might be, it did not translate into investment success. Now, this current administration has a policy to support green energy. And if you look at green energy, one of the main beneficiaries should be companies making solar panels. And I remember that in 2021, in fact, I did look to put solar panels on my roof. Not too long ago, about a month ago, I went to see who were the companies that gave me bids. And one of them was a large company called First Solar. I think it's part of the S&P 500. And if you look at the First Solar stock price over the past 3.5 years since we've had this policy supporting green energy, you would have done really well because the price per share more than doubled. You would have more than doubled your money in First Solar, which might be an indication that perhaps that's something that you ought to pay attention to. Now, I also remember that I went to Costco and there was a booth there for another company called Sunrun. And I also got a quote from them. And I also wanted to see how did Sunrun do. And over the exact same 3.5 years, Sunrun basically lost 75% of the value of the stock. Pretty much the entire, I mean, it's just a huge, devastating loss, even though the two of them started pretty much neck and neck. And I think that's kind of the idea that even though you had the same type of policy applying to both, one did really well, one didn't, because each individual company, you know, their success is driven by much more than the government policy. And interesting enough, I was in Oklahoma not too long ago, and somebody did ask me, well, what if I had actually stuck to fossil fuel, for example, like companies like that? Perhaps it would have been a lot worse because there are no friends that they have in DC, and that's kind of the conventional wisdom. Well, if you, and that's what I did, I look at this over the same exact time period. If you look at ExxonMobil more than tripled in value, more so than than First Solar. So you would have been, well, better served in a way staying in the good old stodgy fossil fuel rather than the green energies supported by the government. So to me, it kind of drives back to the same point. Don't game the system. It's not possible because the markets are too quick to incorporate this. And secondly, the success or not success depends not only on the government policies, but what the company does itself. Now, what about policies at the national level? And particularly, we know that presidents have different priorities. And it was interesting for me to go in my lifetime, born in 1969, to see how the different presidents did, how their policies impacted the stock market, and if there's something that we can learn. And the average growth per year, well, we talked about the annualized return earlier in the webcast, in the US in my lifetime has been about 10%. And I want to use that 10% as a yardstick. So that's what's called the benchmark. So we're going to compare each individual president on an average annualized percentage of what the market returned while they were in the White House to this 10% long term. So when I was born, President Nixon was in the White House. And for the 5.5 years or so that he was president, the markets, in fact, did not grow. They dropped by about 2.9% per year for 5.5 years. And then he resigns, and his vice president, Jerry Ford, comes along, and the market skyrockets at over 20% per year. And then he loses in 77 to President Carter. And for the one term, 4 years, the market goes a bit above average, 11.7%. And then in the 80s, we had President Reagan, really nice outcome. And then his vice president comes along for one term. It's 13.9%, followed by in the 90s by President Clinton. And then we had the Bush versus Gore election when President George W. Bush comes along. And on average, for the 8 years that he is in the White House, the market drops by 4.4% per year on average for 8 years. And then we had President Obama and then President Trump. And the reason I bring this up is that I've kind of like showed this data to a number of people across the country and the world. And I think the first logical question is whether or not there is an obvious pattern telling you that having a Republican or a Democrat in the White House is better or worse for the stock market. And as Sean, I've shown this to so many people, and nobody could tell me, yeah, there's an obvious pattern. It does not seem to be that way. And that's not what most people want to believe. That's just not the case. And then it got me thinking, what about those policies that we talked about? What if I told you there was a president that had incredibly business friendly, but also stock market friendly policies? What if I told you a president that made a point to cut taxes specifically to stock market investing, such as dividends and capital gains? Well, that ought to be like an amazing boon for the market, because that's exactly what all investors want. And we did have that president. It just happened to be President George W. Bush. And yet, if you look at these numbers, you might be tempted to think, well, he wasn't a good president for the market. Well, he did cut taxes to dividends and capital gains, and then the market still tanked. Well, what happened? He walked in just as the dot-com was going bust. How much did he have to do with the dot-com bust? Nothing at all. He, 9 months into his presidency, 9/11 happened, and then walked off at the very bottom of the financial crisis. Is it fair to say that he was not a good president for the market? Not at all. I don't think that's fair. The same way that if you look at President Clinton, he happened to come in just as Pets.com and Amazon and Microsoft were just taken off. And I'm not sure the White House had much to do with that. So I'm not sure that it's fair to give him credit for the outstanding market performance. But people are saying you have a president like Reagan, hyper focused on business, tax cuts, and the market responded really well. It was up on average about 15.8% per year for 8 years. And perhaps there is evidence that having that laser focus on business and taxes is paying off for investors. And one thing I remember, Sean, is that when President Obama was running, there was genuine concern that what if we have somebody who's more interested in social programs and doesn't have the eye on the ball, and then it's going to be a bloodbath in the market, and I really need to sell everything and move to Canada because that's going to be a disaster for the markets, having somebody focused on social programs. And in fact, indeed, his signature accomplishment is healthcare for the country. That's Obamacare. Well, how badly did it get having a president that really is not known for taxes and business-friendly policies? Well, it turns out that during the 8 years, exactly 8 years as President Reagan of the Obama administration, the markets on average went up by 16%. How different is it? 16% from 18? They're pretty much the same. But that's not what people believe. They think, oh my, this is going to be a disaster. It's just, in my view, it's all emotions talking. It's not really the data. There's nothing to indicate in the data that the priorities of the president or the political affiliation really drives the market performance. Now, as we know, presidents are not the only institution, the only thing that really matters when it comes to policy. Congress is also at play. And quite often you hear folks saying, yeah, but what about Congress? They have a big say. How do you consider that? And it gets complicated because if one party controls this, but not that, then it starts splitting hairs, and I don't have many. So 3 years ago, what's interesting, I had this thought because the Democrats had won the 2 Senate races in Georgia. And at that point, they controlled the White House, the Senate, and the House at the same time. So it dawned on me, maybe that's a more natural experiment. What if you look historically at times when one party had full control of the White House, the Senate, and the House at the same time? Because at that point, there's no place to hide. They control everything. You can see, how did the market do when one party was in control versus when the other party was in control. And over the past 90 plus years of data, the Republicans had this single party control for 13 years when they controlled the White House, the Senate, and the House. And if you look at these 13 years, they're kind of spread out over the time frame. On average, among these 13 years, the market went up by 14.52%. So it's a nice growth in the market. And the Democrats also had this unified government control, but it turns out they didn't have it for 13 years. They had it for a lot longer, 34 years. So the question is then, how did the markets do during this Democratic single party unified control? And 3 years ago, when I ran this analysis and I showed it, somebody stood up and said, "Listen, you're going to try to promote one party or another and make me feel good or bad about my views and blah." And like, no. This is what the data is saying, and you really can get it. You make your own judgment. But just to make sure that we got it super right, we had the PhDs in the research group double check and triple check the data. And it turns out that during the 34 years of the Democratic unified government control, on average, the market went up by 14.52%. It is identical to the second decimal. So when people are telling you that the market's do better or worse during a party or another, during one president or another, all this is really, in my opinion, it is all emotions. They're kind of projecting their emotions onto what's going to happen. There's nothing in the data to suggest that having one party or another, one policy or another, whatever it is that you consider, it's just not the main driver of the market. Think about this number, 14.52, identical to the second decimal. And Sean, what I'm saying here is not really that politics and elections don't matter, because well, of course they matter. I mean, to some companies more than others. What I'm suggesting is something different, is that there are so many variables that impact the performance of the stock market and each company individually. And one of them is the politics and elections. But the way I think it is, this is one of the many variables. It's just not a primary one. There's not one that you can link. Here's what happened in the election. Here's what's present or policy to the outcome in the stock market. It's just not really in the data. But rather, the way that I thought about it is something that came along as I was baking cookies with my daughter. And when you put in the eggs, the sugar, the flour, the butter, and you mix it all in, you pop it in the oven. When the cookies bake, and you break it apart, you can't really point and say, aha, I recognize the egg yolk in there. You can't. It's mixed in with so many other ingredients. It's pretty much indistinguishable. And that's exactly what I think politics is. It is part of the mix, but it's the egg yolk in the cookie. It's something that is there somewhere. It's just you can't really distinguish it. And the good news is that it's not the garlic in the cookie. It doesn't stink enough to recognize it, but it's there. And I don't think that you ought to build a strategy around the egg yolk in the cookie, but rather acknowledge it's somewhere in there, let it be in there. But I don't need to make a trade with my money because of politics and elections alone, because that's not a primary driver of stock market performance. And that's ultimately the conclusion that I want people to take from this.
No, Apollo, thank you. I know we're getting close on time, but I like how you finished on that, because I think it's something that I know our firm and my partners have always preached is, developing the financial plan and sticking with it through all kinds of different noise that you're going to have, whether it be economic, global, political noise that we're always going to see.
Yeah.
Apollo, thank you so much for your time. We really enjoyed this. I want to say we didn't have time to get to all of the questions, but we would love to maybe do this again and have you back. I think you're a tremendous asset and a tremendous speaker. Every time, I think the first time I saw you was probably 13 or 14 years ago at a conference, and I'm always, captivated by the complexity of the ideas that you discuss. So we really appreciate your time. Thank you.
And great fun talking to you. Thank you for having me.